This is Nightly Business Report with Sue Herrera and Bill Griffin.
Dramatic finish. The market surges as the bulls gain control of Wall Street, at least for today.
Status update. Facebook marks one of the most difficult periods in its history with a big earnings beat, but weaker revenue and slowing growth rates.
Electric shock. GE's dividend runs out of power. Regulators widen their probe into its accounting, and the stock falls to a multi-year low. Those stories and much more tonight on Nightly Business Report for this Tuesday, October the 30th.
Good evening, everyone, and welcome. What a finish. Stocks rallied all day long, and then they surged into the closing bell. Money flowed into sectors that have been punished recently, pushing tech stocks higher, as well as materials, energy, and real estate. Today's solid gains follows yesterday's big move lower and a month of wild swings that have left investors with a bit of whiplash. So here are the closing numbers. The Dow Jones Industrial Average soared 431 points to 24,874. The Nasdaq was up 111 and the S&P gained 41. And while the gains today were welcome, would investors perhaps prefer to see a bigger pullback before finally heading higher? Mike Santoli tackles that question.
The brutal October stock sell-off has already cut the S&P 500 down by 10%, and the relentless selling has led to index declines on 18 of the past 23 days. Now, traders seeking signs of relief are waiting for a washout. That's when a persistent market decline accelerates to a crescendo of indiscriminate selling, accompanied by a surge of investor panic. Such a decisive flush to the downside often precedes a strong rally attempt, and sometimes even a lasting market bottom. The trouble with playing such a washout is there is no agreed-upon metric for identifying one, and not every steep decline necessarily gets to such a dramatic stampede of the herd away from stocks. But some of the markings of a washout low include more than 90% of all stocks declining on heavy trading volume, accompanied by a rush into safe treasuries that drops their yield sharply. Also, a surge in the market's volatility index to a new high, perhaps above 30, above recent peaks in the high 20s. A recent pattern of half-hearted rallies either soon after the market opens or shortly before it closes have prevented the market from reaching some of these extremes. That's not to say the market needs to fall that much farther in the short term to fully exhaust the selling and heighten investor fright. The current correction could stabilize near these levels with a few days of calm. But ironically, a solid bottom sometimes requires the kind of market action that suggests investors are afraid that the bottom is nowhere in sight. For Nightly Business Report, I'm Mike Santoli.
Facebook is the last of the so-called FANG stocks to report for the latest quarter. The others who have already reported being Amazon, Netflix, and Google parent Alphabet. And the social media giant's results took on greater importance this quarter, given the issues it has been dealing with, like privacy, data breaches, and election interference. So after the bell tonight, Facebook easily beat profit expectations, earning $1.76 a share, when Wall Street's expectations were for $1.47. Revenue was up 33% from a year ago to more than $13 billion, but that was slightly less than expected. So you got volatility in the after hours. The stock initially fell and then moved a bit higher. Julia Borston has more on Facebook's results.
The growth of Facebook's user base is slowing, but the social media giant is still growing its profits far faster than expected. Facebook growing earnings per share by 11% instead of the nearly 8% decline analysts anticipated. Facebook grew its daily active user base by 9% from the year earlier, while monthly users grew 10%, but that's down from 11% growth of both of those groups last quarter. CEO Mark Zuckerberg looking to shift the conversation away from the slowdown in its core service to the health of its family of apps, saying that more than 2 billion people use at least one of Facebook's messaging services every day, saying, quote, "We're building the best services for private messaging and stories, and there are huge opportunities ahead in video and commerce as well." For Nightly Business Report, I'm Julia Borston in Los Angeles.
Dow component Coke went on a health kick, and it's paying off. Higher sales of sugar-free sodas and vitamin water helped that company top earnings and revenue estimates. It also benefited from higher prices, and that benefited the stock price, which rose 2.5%. Sarah Eisen has the details.
A beat for Coke and some of the best growth we have seen in the entire consumer staples industry. Organic growth, which is the industry metric, up 6%. Why? Coke is growing, especially Coke Zero Sugar, which is growing double digits. Diet Coke is finally resonating with millennials after years of declines, thanks to new flavors and slimmer packages. Waters, specifically sparkling water like Topo Chico and Smart Waters, continuing to do well. Those are some of the highlights, and it really was a global story of strength in what's been a more difficult economic environment around the world.
There's clearly, as we've gone through the year, the headwinds have got a little tougher. The macros around the world are perhaps softening a little, particularly in some of the emerging markets and coming into Q3. And we've seen that affect us in the exchange rate. Obviously, being in over 200 countries, we're bringing money from around the world back into US dollars. And that's gone against expectations and turned into more of a headwind coming into the second half of this year.
The strong dollar did shave a few points off of Coke's profit, but the takeaway? The company has implemented a turnaround under CEO James Quincy, spinning off some of its bottlers, focusing on beverages that are growing, focusing on brands that are doing better around the world, and simplifying the business. He also made some big deals during the quarter, buying both Costa Coffee for $5 billion and investing in Body Armor, a pace of deal-making that Quincy says will not necessarily repeat itself in other quarters. But that is what makes Coca-Cola such a standout in what is a very little to no growth industry of beverages, food, and household products. Much like P&G, which just had its best sales growth in years, also realizing the fruits of a turnaround. For Nightly Business Report, I'm Sarah Eisen.
And another Dow component, Pfizer, reported a mixed quarter. Earnings topped expectations, but revenue fell short, and the company narrowed its full-year forecast overall. Pfizer cited pricing pressures on some of its medicines, along with increased generic drug competition, and as a result, that stock fell a fraction on this big update today.
And then there is General Electric. The embattled conglomerate slashed its dividend to next to nothing, and regulators expanded their probe into its accounting. This after reporting quarterly results that came in below expectations. The pile of bad news pressured that stock, sending it down more than 8% to just about $10 a share. Morgan Brennan has more.
It was another kitchen sink quarter for General Electric as the company slashed its dividend for the second time in less than a year. The move came as the industrial giant struggles to turn itself around with a new CEO 30 days on the job.
I know there's been renewed speculation on our future strategic direction. The strategy we announced on June the 26th to create a more focused portfolio that sets up our businesses to win and strengthening our balance sheet is today the right plan going forward.
That strategy involves spinning off healthcare and exiting oil and gas over the next few years. Larry Culp used to run Danaher, where his tenure yielded strong returns. For GE, he plans to unveil a bigger plan in early 2019. But today started the process with two changes: the restructuring of the power business, which continues to suffer and overshadow better performing units like aerospace, and also the drastic cut to the quarterly dividend from 12 cents down to a penny. Many on Wall Street expected that cut, but given GE's long-standing reputation for a reliable payout, the move speaks to the company's continued cash crunch.
You know, very large percentage of the shares are owned by retired employees and individuals, and those folks, a lot of them were relying on the dividend. So although I agree with the decision to eliminate the dividend, because they certainly need that extra cash for restructuring and dealing with liabilities like a dramatically underfunded pension.
But today's results left more questions than answers, since GE didn't update its guidance, but did disclose broader investigations into its accounting practices, as both the SEC and the Justice Department probed several multi-billion-dollar charges, including one detailed today for the power business. For Nightly Business Report, I'm Morgan Brennan at the New York Stock Exchange.
Time to take a look at some of today's upgrades and downgrades. We begin tonight with Nordstrom, which was upgraded to outperform from neutral at Wedbush. The analyst there cited the potential for revenue and gross margin expansion over the next several years for the retailer. Price target $75. Nordstrom shares finished up nearly 7% today to $66.90. NVIDIA was upgraded to overweight from neutral at JP Morgan. The analyst cited the stock's recent underperformance and sees stronger long-term growth ahead. The price target $255. Shares rose 9% to $203 even today.
And also at JP Morgan, shares of JetBlue were upgraded to overweight from neutral. The analyst cites the stock's valuation, calling it the cheapest stock of the domestic airlines. The price target is 20. JetBlue shares soared 5% to 17.08. That same analyst downgraded Southwest to underweight from neutral. The analyst says the stock price is stalled out. The price target is $52. Shares rose 2% to $49.15.
Coming up, the one concern that many Republicans, Democrats, and independents share as they get ready to cast their votes in next week's midterm election. Former Federal Reserve Chair Janet Yellen made some comments on the economy this evening. Speaking at the Schwab Impact Conference, she said that she's concerned that the economy could overheat and that a couple of more interest rate increases are necessary. She also said that the market volatility reflects the uncertainty surrounding the global outlook right now.
The home ownership rate edged higher in the third quarter, this as younger buyers entered the housing market for the first time. According to the Census Bureau, the total share of American households that own a home inched up to 64.4%. Separately, home prices rose 5.8% in August compared to a year ago, and that is according to the Case-Shiller Home Price Index. That is the first time in a year that the index has come in below 6%.
Well, with the midterm elections just a week away, there is one issue that investors across the political spectrum will be thinking about when they go into the voting booths. Ylan Mui tells us what it is.
Come on down, you're the next voter.
It's one thing that voters from both political parties agree on: concern over the rising national debt. That's the upshot of a new poll by the nonpartisan Peterson Foundation. Republican, Democrat, or independent, roughly 3/4 say the debt is a factor in who they'll support in next week's midterm elections.
They know that the debt affects the economy and it affects their way of life and their incomes, and they want Washington to do more about it.
The foundation has long called on lawmakers to rein in spending. The deficit ballooned to $779 billion over the past year. That's a jump of 17%. Next year, it's forecast to hit $1 trillion. But not everyone sees trouble on the horizon.
People have heard for decades that large budget deficits are bad for the economy, and yet the economy is doing quite well. I mean, the unemployment rate is at an almost 50-year low, yet we have this very large budget deficit. So I think it's pretty hard to convince people that it's really that big a problem.
President Trump is asking his cabinet to cut costs.
I would like you to come back with a 5% cut. Get rid of the fat. Get rid of the waste, and I'm sure you can do it. I'm sure everybody at this table can do it. It'll have a huge impact.
But both Republicans and Democrats are floating proposals that critics say come with big price tags. Trump wants a 10% tax cut for middle-class households. Democratic Senator Cory Booker wants to give every child a $1,000 savings account. And Senator Kamala Harris is calling for a new tax credit worth up to $6,000 per household. The cost to the country? An estimated $3 trillion.
The problem is sometimes campaign promises do become reality. And so to the extent elected leaders are running elections and trying to win with making promises that we can't afford, that's a dangerous thing.
What do voters really want to see? Peterson says it's politicians reducing the deficit by reaching across the aisle. For Nightly Business Report, I'm Ylan Mui in Washington.
All right, so what does the market want to see from the midterm elections? Jeff Bush is back with us. He is a partner at the Washington Update, and he joins us now with his thoughts. Good to see you back with us, Jeff. Welcome.
Thank you, Sue.
You make the point that, in your opinion, the markets have priced in a Democratic House win. If that is the case, what has the market not priced in right now? What might surprise the market a bit?
Well, I think there are two potential surprises. One, that the Republicans would actually maintain control of the House, and I think we'd see an immediate relief rally. But at some point, the market's going to remember that there are some systemic issues that we have to deal with: rising interest rates, the tariff discussion, trade wars, and the like, which will tamp that rally down a little bit.
Clearly, the economy's in good shape, Jeff. Unemployment, growth, you name it. Does that resonate with voters right now, in your view? In other words, does the president have coattails that will extend into the House and Senate campaigns this season?
Where the coattails exist, I think they exist very long coattails. The problem is those coattails are not universally across the country, which is very common for a president in his first midterm election. So in Texas, for example, I think those coattails do exist. We saw some very interesting polling today that showed that 86% of Texans believe the president is doing the right thing and following the right policies. And you have to believe that's going to be very beneficial to Ted Cruz and the Republicans in the House in Texas.
You've made the point, you said, when you talk to people and you go out and you talk to institutions, that depending on the outcome of the midterms, that the president will find himself at a crossroads. What do you mean by that, and how do you think he will react to it?
Well, that's exactly what we're talking about. The president, after the election, at some point, he'll have to face the fact that he is at a crossroads, assuming the Democrats do take the House. And I think he has a choice at that point. He can double down on the Republican all-base strategy that he's used over the last 2 years, or he could pivot to a 1996 Bill Clinton-esque type of return and to try to get something done. If he does go the direction of trying to get something done, I think the most likely candidate there would be an infrastructure program under the guise of a jobs deal. If he decides to go the all-base Republican strategy, that's where I think he would double down on tariffs, really ramp up the discussion around immigration, because tariffs and trade are the one areas that President Trump has a tremendous amount of authority.
However, if the House goes back to the Democrats, what do you think that does to his strategy on trade and tariffs and so forth?
Well, again, the president has a lot of authority as it relates to tariffs and so forth, so he can continue down that road. That's why I believe if he does go that all-base Republican strategy, that we could see a redoubling of the president's efforts in that space. Where we could see some trimming of the president's agenda, obviously, would be tax reform. That's going to be off the table at the moment the Democrats win the House and are installed in January.
Mm-hmm. Jeff, thank you so much. Appreciate it. Jeff Bush with the Washington Update.
Thank you.
Well, some market watchers say the president's comments late last night that he expects a great deal with China on trade may have contributed in somewhat to the day's market rally. But Chinese officials were not so pleased after those reports yesterday that the White House was considering an additional round of tariffs on Chinese goods. Eunice Yoon has that reaction tonight for us from Beijing.
China dismissed talk of more tariffs from President Trump today. The foreign ministry said the U.S.'s noise won't intimidate China. Reports said that the Trump administration would impose more tariffs on China if talks between President Trump and Xi at the G20 meeting next month resulted in nothing. The announcement could come as early as December and would cover the rest of the Chinese goods that are currently not subject to tax, about $260 billion worth or so. More tariffs would put greater pressure on American companies here. A recent survey by the American Chamber of Commerce in South China found that 64% of U.S. companies polled were considering relocating production lines to outside of China because the trade war was hurting profits. The foreign ministry also reacted to the U.S. Commerce Department's export ban on a Chinese chip maker, saying China hoped the U.S. would do more to enhance trust rather than damage it. The state-backed firm, Fujian Jinhua Integrated Circuit, has been accused by U.S.-based Micron Technology of stealing secrets. But under the ban, the company won't be able to source important components from U.S. suppliers. The Commerce Department said the decision was made on national security grounds. And that is adding to a growing feeling in China circles that the real goal of the Trump administration is going beyond trade and instead is to decrease America's dependence on China. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Under Armour's turnaround takes hold, and that's where we begin tonight's market focus. The athletic wear maker topped earnings and revenue estimates and raised its earnings outlook for the year. The company attributes the strong quarter to a rise in sales overseas and fewer promotions. Under Armour shares jumped more than 24% to $20.97. Americans are swiping their MasterCards a lot. The company reported stronger than expected earnings and revenue for the third quarter, thanks to higher consumer spending. MasterCard shares, though, were off more than 1% to $187.73. Profits at BP hit a 5-year high. Earnings for the quarter more than doubled and were bolstered by stronger oil prices and cost cuts. The company says production during the first 9 months of the year rose thanks to the tapping of new oil fields. Shares of BP rose nearly 3% to $42.21.
Aetna reported a profit of $1 billion in the third quarter on growth in its Medicare and Medicaid health plans. The company saw its membership rolls rise as well. Aetna's better-than-expected results arrived just as the company nears the completion of its takeover by CVS. Shares rose 1% today to $197.65. Tapestry turned in a strong quarter thanks to an increase in demand for its Coach and Kate Spade handbags. The company plans to pull some inventory, though, from department stores and cut back on flash sales as a way to maintain its exclusivity. And the CEO today said that he believes the trade war with China is manageable.
Today, in fact, between 3% and 4% of our handbags come from China. So we don't see a great impact from any duties. And we indeed today announced that all of our impact this year, the 10% duty on travel goods from September to December, which could become 25% starting from January, has been embedded in our guidance.
Well, despite all the good news, shares of Tapestry fell 1% on this rally day to $40.32. And Chesapeake is buying Texas oil producer Wild Horse Resource Development for $4 billion. That company says that the acquisition will significantly boost its oil production. Chesapeake has historically focused on natural gas production. Investors didn't seem to like the deal, though. They sent shares lower by 12% to $3.27.
Coming up, Amazon's search for a second home.
Amazon and Nashville. Can they make beautiful music together? I'm Scott Cohn in another of the HQ2 finalist cities. We'll look at how Nashville stacks up. Coming up on Nightly Business Report.
Waymo has become the first company approved to test autonomous vehicles without safety drivers on public roads in California. Until now, California has required those vehicles to have a safety operator in the driver's seat. The permit gives Waymo a leg up on its competitors like Cruise, which is testing self-driving vehicles in San Francisco. Waymo is owned by Google.
Apple CEO Tim Cook was in Brooklyn, New York today to unveil a number of new products.
It's time for a new MacBook Air. One that takes the MacBook Air experience even further in the areas that are most important to our customers. And of course, what we all want in a MacBook Air is a Retina display.
The MacBook's new design is noteworthy because it had gone relatively unchanged since 2010. The company also released a revamped Mac Mini and an upgraded pair of iPad Pro tablets. All of the new devices will have higher starting prices. The Mac and iPad have combined annual revenues of $45 billion.
Amazon is still promising a decision this year on where it will locate its $5 billion second headquarters. But as we head into the final 2 months of the year, speculation is swirling among the 20 finalist cities. Scott Cohn has been visiting all of them, and tonight he reports for us from Nashville, Tennessee.
In Music City, USA, they're convinced Nashville strikes the perfect chord.
We have the lowest taxes and lowest debt per capita in the country, and people realize that we value business here.
It's a catchy tune. The Tennessee economy grew by a solid 2.5% last year, above the national average, with job growth among the best in the nation. Despite that, cost of living is a bargain, among the lowest of any big city in the country. And in a place where countless people have sought fame, they think Amazon and the 50,000 workers it plans to hire can find exactly what they need here.
They're looking for friendly, they're looking for open, they're looking for opportunity.
There are some sour notes. Tech talent is one of Amazon's top priorities, but fewer than 5% of Tennessee employees work in tech, the lowest concentration of any of the finalists. Attracting more talent could be a challenge. Nashville is wrestling with crime and health care in one of America's fattest cities. Commutes are getting longer as this city grows, but voters just rejected a new mass transit package. No shortage of concerns here about the growing pains HQ2 would cause in one of the smallest finalist cities.
They realize wherever they go, they're going to have a huge impact, and they want to make certain they've thought that out well.
Nashville hasn't gotten much buzz in all the speculation about HQ2, but in the end, that might not matter much. Just being named a finalist has brought some attention to an unsung hero in the economic development world, a little bit of stardom in a city where stars are made. For Nightly Business Report, I'm Scott Cohn in Nashville.
Before we go, a look at the final day on Wall Street, a rally day with the Dow soaring by 431 points. NASDAQ was up 111. The S&P gained 41 today.
Let's see what tomorrow holds. That'll do it for us tonight. Thanks for joining us. I'm Sue Herrera.
I'm Bill Griffith. Hopefully it's not a trick.
Trick or treat, I know,
tomorrow, yeah.
exactly.
Have a great evening. We'll see you tomorrow.